Welcome back to our last video of our mini-series, Profiting with Index Universal Life. In today's video, we're going to be going over design considerations and answer the question of why blending our policy is so important. We'll also look at a policy example that we like to put together for our clients, as well as a not so great policy design that we see from other agents. The proof is in the pudding, as they say, and the best way to tell if your policy is optimized is to look at the numbers. This coincides with a big driving force here on the channel, which is education. Ultimately, we want our clients to understand the product and how it can be used as a tool to build their wealth. When our clients understand the unique advantages and tax-free capabilities of permanent life insurance, in this case, Index Universal Life, the more they'll agree with us of its usefulness and why the asset is, in our opinion, irreplaceable. If you've seen our videos before, you'll understand why we call this the foundational asset, where we get uninterrupted compound interest that we can access tax-free. By the end of the video, you'll know what to look for in your own policy and, more importantly, why. So let's get at it. By the way, in case we haven't met, my name is Joseph Gutierrez, and this is Covered in Compounding. Click like and subscribe to learn how we use high cash value life insurance as the foundational asset to build our wealth over the long run. So what do we mean when we say blending our policies? Well, blending refers to reducing the base death benefit portion of a life insurance contract and also adding supplemental term rider to it. We do this to bring down our costs and maximize the amount of premium dollars that can go to work for us inside the cash value account. The more term we add to the policy, the higher our IRS MEC limits will be. This means we can put more of our hard-earned dollars to work for us inside the cash value account. That cash value account accrues interest based on a market index with a 0% floor. The cash value is the equity of a policy and is what we can draw from, or better stated, loan against. Ultimately, by blending supplemental term into our policies, it can help us grow in the near term as well as the long term for cash value and death benefit. So instead of having, say, $500,000 of fully based permanent index universal life coverage, we would prefer to have, say, $100,000 of base permanent coverage with an additional $400,000 of supplemental term added on. Dollar for dollar, the cost of term insurance for a 45-year-old healthy male may be on the order of about a fifth the cost compared to the base portion. That insurance cost savings is monumental in reducing our total policy costs and pumping up our cash value over a lifetime. And we'll see this in contrast in the illustration portion of our video. Now, the concept of blending term into a permanent life insurance policy isn't particularly new. This is actually much the same as what we do with whole life policies. If you've heard the term infinite banking, you'll recognize the general structure. The policy is constructed with a lower base amount of coverage and a term rider added to push up our IRS MEC limits and lower our costs. The main difference here is that we don't have to put money towards paid up additions. Instead, we just put our premium dollars into the policy, and whatever amount is over the cost of insurance and general policy costs, that amount goes towards cash value. This is the basic design principle behind Index Universal Life in the first place. IUL is known as a flexible premium adjustable permanent life insurance policy. By flexible, we mean premium contributions can be scheduled, unscheduled, increased up to our limits, sporadic, or halted altogether. At a certain point, as long as the cash value is sufficient, the policy will run itself without further contributions, as we'll see later in this video. That, and it stands to reason, the more cash value we can get into the policy as soon and as efficiently as possible, the better our growth will be. Better our growth is, the more we can pull from it, preferably in a tax-free manner. So what about this term rider? Well, the term rider is made up of ART, or annual renewable term insurance. Annual renewable term is the most fundamental type of life insurance. It's a 1 year term policy with renewal costs that are recalculated at every policy anniversary date. So it goes to reason the cost of $100,000 of ART term for an 18-year-old will be less expensive than a 25-year-old, and a 25-year-old will be less expensive than, say, a 55-year-old. Every year we hold ART term, the cost recalculates. Now, its price is not particularly linear. It's actually more parabolic, and the difference in cost is relatively low under age 55, and it starts to accelerate as we age past 55. And we can see this in the general ART tables. Now, if you're thinking, well, wouldn't that be a problem later in life as far as the cost getting too high? Yes, it would be if we didn't have two embedded design features. First, the most obvious solution is to turn off the term insurance when we don't need it anymore. We typically do this when we stop funding our policy and are getting ready to take income in retirement. By that point, our cash value and death benefit has grown substantially, so the term insurance really isn't needed anymore. It's done its job for us, and the term rider can be turned off. The other design feature is actually a built-in safeguard based on our next item in design considerations, the guideline, premium, and corridor test. But before we get into that, a little bit of background. Back in the 70s and early 80s, when basic universal life was first coming on the scene, there wasn't a terrible amount of regulation associated with it. What people would do is design these relatively small policies, keeping their costs super low, and then just dump in vast amounts of money into their policies, like millions of dollars. Back in those days, the fixed yield from the general account was much higher, so people were getting like 8 to 12+% compound interest year after year, with no tax implications and no investment risks. This means that many investors were abandoning their classic investment portfolios with their investment advisors and broker dealers. Eventually, the complaining of lost business from many other financial professionals got overwhelming. Essentially, this was because they could never compete with these low to no risk, tax free growth slash access prospects of index universal life policies, which should tell you something, by the way. The government eventually caught wind and put together a sequence of legislation from TEFRA, DEFRA, and lastly, the TAMRA Acts. This legislation put basic tests and caps on how life insurance could be designed and classified with those tax-free measures built in. One of the products of this legislation is the guideline premium and corridor test. This test defined the maximum amount of money that could be contributed to a policy per year based on the total death benefit. So if a 45-year-old male wants to dump in, say, $100,000 of premium contributions into their policy every year, he'll need a total death benefit closer to $2 million and not $60,000. Another feature of the test is the corridor portion of the test. So because index universal life costs do adjust as the years go by, and since universal life is fundamentally a cash value accumulation product, the IRS said as the insured ages, the amount of insurance needed to qualify for its favorable tax treatment also decreases. And because with index universal life, our policy insurance requirements are merely the difference between the death benefit and the cash value, sometimes referred to as the net amount of risk. So as we age, the corridor requirements automatically reduce, and the less insurance we actually need to meet that classification life insurance. Less insurance requirements means less costs, which means better performance, especially in later years. This is a feature that most of my clients appreciate with Index Universal Life. Consider the example. We have a younger family of 40-plus-year-old working professionals with children, 2 cars, and a mortgage. In the early years, they need a lot of insurance, obviously to cover their liabilities as well as a potential loss of income. Let's say it's $500,000 of insurance per working adult. So they put together index universal life policies designed correctly with a healthy amount of contributions to cover the cost of insurance and to contribute to cash value growth. As time goes on, their cars get paid off, their children grow up, savings accumulate, and their mortgage gets paid down. Later in life, towards retirement, the priority has shifted from high liability coverage to instead more towards retirement income and savings. Luckily, because Index Universal Life is multifaceted, the policy has grown with them. Now, with appropriate funding and mirroring stock market performance, their IUL cash value has grown to 1.5 million over the last 30 years. Now, as 70-plus-year-old adults, because of the GPT test, their required amount of insurance differential has lowered to, say, $180,000 of total of death benefit, not the initial 500,000. The cost of insurance per dollar increased because they're obviously much older, but because of the GPT test, they only need about $180,000 difference between their cash value and death benefit to qualify for those tax-free advantages of IUL. So their final death benefit may be roughly $1.68 million with a cash value of $1.5 million, with their cost of insurance reflected in that $180,000 difference. This brings down our cost in later years substantially. Not only that, now they can start taking tax-free income based on the 1.5 million amount for the rest of their lives if they choose, which we'll see an example here later in the video. This required net amount of risk, or sometimes referred to as the IRS corridor, continues to tighten as the policyholder gets older to the point where, if designed correctly, at age 95, the required insurance amount goes to zero, meaning there's no more insurance costs. If we take a step back and look at a policy over the course of a lifetime, the policy has morphed from a much needed death benefit in early working years to a tax-free retirement check option in later years with low cost requirements as well as a large tax-free death benefit. This is the beauty of Index Universal Life because it manages our costs efficiently and grows our tax-free wealth. In recent years, as word has spread, we've seen an influx of new policyholders because of these realizations. Usually we hear dissatisfaction with taxable traditional 401k IRA accounts as the main driver. That's a totally different video altogether. So let's summarize our basic design and overall policy objectives. First, only put as much total death benefit, the base plus the term, as we need to cover our liabilities as well as required to maximize our IRS/MEC limits. Second, blend that supplemental term to further lower our net policy costs over the life of the policy. Next, maximize our premium contributions to grow our tax-free wealth inside the cash value account. Then, use our cash value during our working years as a tax-free line of credit via those policy loans. Next, reduce or remove term insurance rider when we are at retirement or when we stop making our premium contributions. And then lastly, annuitize. Give ourselves tax-free income with those same policy loans if we want to. So now that we have the basic understanding of construction and blending, let's go ahead and take a look at policy designs and things you should be looking out for in your own policy. Okay, so now let's go ahead and take a look at a not so great design and a design that we like to put together for our own clients. Okay, first we'll start off with the not so great design. And we're going to be using the same individual here, a hypothetical 45-year-old male, preferred plus, non-tobacco rating, putting in $20,000 into his policy year after year until he reaches the age of retirement 20 years later. Okay. So in the first example here, we're going to be looking at, and throughout all these demonstrations, we're going to be looking at one of our preferred carriers, Allianz Life. We'll focus in here on the supplemental illustration. Okay, so if you're relatively new to design here, we have some basics that we'll quickly go over here. All right, so first, obviously, we want, for this particular client, they're putting in $20,000 towards their policy year after year. They're a 45-year-old male, and in this design, they have a total death benefit of $500,000. Okay, so this is the not so efficient design because that full $500,000 is fully base permanent life insurance. So, okay, and with that, increases our cost, which we'll see. So in our first year here, we have our $20,000 outlay. We can see our total charges, which includes the cost of insurance, general policy charges, as well as the premium load fee. And Allianz does this quite well. Just put in one total number here. In our first year, we can see about just under $5,500. of cost. Okay. In the next three columns here, we'll briefly go over. We have a current value, a cash value, and a death benefit. So the current value, you may see this with other carriers. They'll call this the accumulation. So kind of the accumulation portion of the cash value account. So the accumulation portion of the cash value account is what the percent of indexing crediting is being applied towards. Okay. So every year, in this case, it's 6.65 is the illustrative rate. In reality, it's going to be up and down. Some years going to have a 15% year, some years going to have a 0% year. For illustrative rates, kind of a safe assumption here, about 6.65%. So that 6.65% is being applied to the current value, so that cash value bucket, if you will. Okay. The next column here is called what they call cash value. Some other carriers that may call this the surrender value. Okay, so that is the amount that is available to us minus any surrender value charge or any policy loans that are outstanding. Okay, so what we can see here in the first year, we do not have any available cash value. Now, $15,751 is going to work for us, but the available cash value that we can draw from is unfortunately a big fat goose egg. And that's the first thing that we kind of notice if our policy is not designed efficiently. We'll start seeing very small numbers in the available cash value or the surrender value account. And then lastly, we have a death benefit account, which is fairly self-explanatory. Okay, so this policy design is an increasing death benefit option here. And we can see that as the cash value account, the accumulated cash value count goes up, so does our death benefit by the same measure. Okay, so in the first year, we put in $20,000, 15,700 some odd dollars is working for us. Okay, that's with that percent increase from the indexing. But we have zero available. The next year, put in another $20,000. Our charges do go down a little bit. That has to do with the premium load fee. The premium load fee of an Allianz, the accumulator product, is 9% the first year and then it's 5% thereafter. So that's with the small differential there. And then we see our current values, $33,000, 33,500 some odd dollars. But our available cash value is only 12,919. So what we see here is that the accessible cash value is kind of stunted quite a bit. Now, this client here is putting in premium towards the policy year after year until age 65. Okay, so age 65, he's putting $20,000 year after year, putting in a total of $400,000. At the end of that time period, his cash value, assuming the illustrative rate, it will be somewhere around $741,000 with that same $500,000 differential. Remember, their death benefit is just in that differential between it, the cash value. In this case, it's $500K, right? So in this case, we can see that our death benefit is $1.2 million and some change. Okay. Time goes on, we can see that our cash value is growing. It's doing all right. But our costs are also a little high. And as time goes on, let's say we look at the next page here in our illustration, we can see that by year 80, our total charges are significantly higher at $11,500. Our cash value and death benefit have grown as well, which is great. But our total charges are increasing as time goes on. We can kind of see that. Let's say we live a long, healthy life with advances in modern medicine and good lifestyle habits. Let's say we get to age 95. We can see our total charges are still super high. We've grown significantly to $97,000 per year. Now, we do have almost $5.5 million, but yet we are paying quite a bit for that differential here that we can see of $500,000 between the death benefit and this cash value. Okay. So that is an example of maybe a not so great design. We have a lot of cost. Our policy has grown. It's still okay, but it's not optimized. So let's go ahead and take a look at a better design. Okay, this is the same $500,000. The main difference is that we have $100,000 of base, and then we have another $400,000 of supplemental term for the total $500,000. We can see here right off the bat that our $20,000 going in the same year. So we're putting the same contributions, same total death benefit. Total charges are significantly less, right? We have total charges of less than $3,000 in the first year. And when we go back to the not so great design in our first year, we had almost $5,500. Back to the good design. Our cash value is $18,000, or excuse me, our current value is $18,400. So that's what's going to work for us. And our cash value is not zero anymore. Now it's closer to $14,167. So a good percentage, the majority of that $18,000 is going to work for us, or is going to work for us. That amount, $14,000, is accessible. We look back at our bad design, only $15,700 some odd dollars was going to work for us, and we had zero available. So a huge difference. We also see our death benefit grow. So let's assume that we have the policy for the same period of time. So those current policyholder holds it all the way into retirement. Let's say 65 years young, if you will. His total charges in his 65th year is $2,700. And he has a cash value of $835,000. And we see our 1.3 million. So we still have that differential. At this point, pursuant to our strategy that we've talked about, our client here, our initially 45-year-old client, male client, decides, you know what, I'm not going to make any more contributions to my policy, so let's reduce that term. Let's take that term off and reduce it to whatever the corridor test requires. So we see, when we do that, we see our total charges drop off significantly. It went from $2,700 down to $982. We also see that our death benefit recalculates slightly downward to $1 million. Our cash value kept going up. We still have that 6.65% working for us year after year. And we've reduced our costs so that while we hold the policy through retirement, our total charges are much more manageable. Now, the interesting thing, if we look back at our bad design, or not so great design, we see heightened charges that are getting into the tens to $20,000 plus, while in our better design, we see most of our charges are remain down. And in our 95th year, our charge is only $13,000, while in the bad design, it was closer to $97,000, which is significant. Another thing to keep in mind is that, according to this illustration, we're growing at 6.65%. That's the illustrative rate, right? So this policy has these built-in protections we talked about in previous videos. We have the 0% floor, and we're getting market-like returns. In reality, it's probably going to be closer to 8.5% if the next 10 years was similar to the last 10 years. We also see something kind of interesting. Let's hone in at our 70th year here. For better yet, let's look at our 75th year. Our cash value is 1.7 million. Our total charges are 1.6 thousand, almost 1.7. What's interesting is that if we kind of compare this to the other side of the investment world, working with a financial advisor, broker dealer kind of type, usually their charges are kind of like 1% asset under management charge, things like that. So 1% of 1.7 million would be about $17,000 a year if we had it with a broker dealer or some kind of investment professional. Yet with our policy, which is a multifaceted policy, our actual costs are a tenth of that. So our actual costs are closer to 1.7 or $1,700, not 17,000. Just something to keep in the back of your mind. We're getting market-like returns. We have a floor of 0, so if we have a bad year, we don't suffer those losses, and our charges are significantly less. And what's nice about this is that we're getting our illustrative rate, 6.65 year after year. So we're growing, let's say between the 76th to 75th year, what is that? About $130,000 of gain. So we got $130,000 of gain. Yet our costs are closer to 1,600. So this is what we were talking about earlier when we said that we essentially don't have to put money into our policy anymore. It's the engine that runs itself. The cash value is covering our cost very easily. And that increases not only our death benefit, but also our cash value over the long run. So we can see by our 95th year, our death benefit is 7.3 million. While if we look back at our bad design, our death benefit was not even 6 million, about 5.9 million. So our policy had more accessible cash value in early years, has more accessible cash value in later years, has lower charges, and it has increased death benefit as well, all for blending our policy design. And this cannot be overlooked. It makes a huge difference in the amount of capital that we can generate for ourselves, then utilize in a tax-free manner, and then that tax-free death benefit ultimately. Now, the next thing I want to go over is what we can use our policy for. So here's a hypothetical example with the same good design feature here where we have the $100,000. Okay. So in this example, our client here is doing the same $20,000 per year. And in his 55th year, he pulls out a policy loan, an index loan of $50,000 right here. Okay. So we take out the $50,000. Let's say he wants to buy a car or put into investment or whatever, help his kids' college fund. Takes out $50,000 and decides, you know what, I'll pay it back over the next 5 years. What's interesting is that we see is that when we take out that $50,000 index loan, we see that there's a differential between the current cash value and the current value and the cash value account. But we see that the differential isn't quite that large. Obviously, we're still in the surrender period. But as we pay our policy back 5 years later, we pay the $50,000 plus interest. We see that we get back to the same level that we once were. So our current value and our cash value by the end, you can see right here, equal each other. So we kept accruing interest in the background on this current value. You notice that that $50,000 did not affect the current value account, which is where our interest is being applied to. We just had a loan out against this current value, which is basically collateral for that loan with the insurance carrier. Insurance carrier doesn't mind. They have to pay out that money anyways in the event of a death. So if you want to take out a policy loan, they're fine with it. So when we pay ourselves back, we assume where we would have been had we not taken out the policy loan at all. Quite nice. This is that uninterrupted compound interest effect. So we paid ourselves back plus interest to the insurance carrier. And let's say we're getting ready for retirement. Now we want to use that annuitization option. We want a tax-free check in retirement year after year and use our policy as an asset to do so. So let's take a look at year 66. So we start taking out income. We can take out, using that same index policy loan, $76,695 per year. And we do so year after year, all the way through retirement. And we could hypothetically take it for the rest of our lives. If we live to 120, we could still be taking out $76,000. Okay. Now, $76,000 is just what the illustrative software produced. You can do more, you can do less, right? Depending on how much cash value you have. But in this case, basically, we're pulling out about $76,000 year after year. Our policy costs are stunted, right? We don't have a lot of policy costs. We give ourselves this $76,000 tax-free check. Oops. Tax-free annuity check, if you will. And we see that our current value and cash value reflect the differential, but we're getting a positive arbitrage effect here. Now, take a look. Let's take a look at the 69th year to the 70th year. We pull out $76,000. We have a small $400 charge for fees and such, policy costs. We see between the 69th year and the 70th year, our available cash value only went down about $20,000, but we pulled out $76,000. Why is that? Well, we're still growing 6.65% on this, in this case, $1.1 million. So we're offsetting our costs significantly. We're pulling out $76,695, but our account is only, our accessible cash value is only decreased by $20,000. This is how we stretch our dollars in retirement and build wealth over the long run, and meanwhile still have that large death benefit for the next generation. Now that we've reviewed the good and bad policy designs, we're left with a common question. Why don't all insurance agents and advisors put blended maximized policies together? For a lot of my clients, they didn't even know that blending was possible. Why hadn't their past agent informed them about it? Well, the answer is simple, but often put in convoluted terms. A lot of times, agents will make up arguments against blending or maximizing their clients' policies. One of the more common arguments, or better put, scare tactics that we've heard, is that the ART tables and cost of insurance could change, meaning that the insurance carrier could increase their costs associated with the term rider. Now, on its surface, it may sound plausible, but in reality, it's unrealistic. Remember when we say ART is the most basic form of life insurance. ART costs are associated primarily with mortality costs and expectations. The older we get, the more likely we are to pass, and the more likely the insurance carrier has to pay out that amount. One important thing that we do have to realize is that the ART cost of insurance never really change, and for good reason. Actually, we can see this in the guaranteed column of an IUL illustration. Those expenses are based on mortality tables and life expectancy of individuals back around the 1920s, when life expectancy was 20 years sooner than today's life expectancy. Which is why changes to the ART tables haven't really happened and are unlikely to happen. Longevity and general health improve year after year, which keeps the cost down and the actuaries at the insurance carrier happy. So sure, if Suddenly, all the advances in medicine completely regress for 30 plus years. The S&P 500 returns zero here on out. Then the average mortality drops to 60 years old instead of the increasing trend of high 70s, low 80s. Then in principle, the ART and general cost of insurance could go up. That, and including we had a near mass death event with hundreds of thousands of insurance claims, a true zombie apocalypse scenario. In recent history, the time where ART tables could have changed substantially would have been during those COVID times, but we didn't really see that. So, what's the real reason that these agents dissuade their clients from blending and maximizing their policies? Are you ready? Because they lose a lot of commission. Yes, commission will drop significantly when blending is incorporated, sometimes as much as a tenth of what the agent would have made without blending. Yes, agents will keep their client in the dark about maximizing their policy with blending, or at least try to convince them otherwise if they can. I see it over and over again, and I have to educate my clients as to why. So now you know. Of course, we don't do that here. Covering compounding, I'd rather give my clients the best designs possible so they can maximize their tax-free wealth over the long run. Generally, it pays us back tenfold with referral business, so I don't think much of it. After all, much of this channel is educational based, so my clients can get the best the industry has to offer. Thank you for watching our video. In today's video, we went over the basics of policy design and consideration to maximize our cash value and death benefit. We saw that by blending our policy, by lowering our base and increasing supplemental term insurance, we can increase our accessible cash value in early years and maximize it in later years as well. We went over basic design concepts for the GPT test and considerations to best design our policy to benefit us over the long run. Remember, we're doing this to build our tax-free wealth and use this as the foundational asset, getting that uninterrupted compound interest that we can access tax-free. We also went over reasons why a lot of agents don't like to put these types of policies together and what you should be looking out for so you can put the best policy together. If you would like to explore putting a policy together and utilize our help in doing so, feel free to click the link in the description, which will take you to our website, where you'll be able to see much of our information, including a book now button for your free online consultation. During that consultation, we'll go over the basics of your financial situation and how a policy can best augment and build your wealth over the long run. We also do free policy reviews. So if you do have a policy from another agent, feel free to bring it to us. We'll take a look and see if we can possibly do something better for you. Once again, thank you for watching our video. Click like and subscribe, ring the bell, leave a comment, and we look forward to seeing you on our journey towards financial independence utilizing the foundational asset. Until next time.